So in this video, I want to talk about the difference between like your normal type of investing versus your speculation type of investing. Because investors and traders, you know, you're going to take on a calculated risk when you want to make some money in the market. And the level of risk undertaken in in like whatever transaction you're going to make is going to be the difference between whether you're investing or speculating. And whenever a person spends money with the expectation that the endeavor will return a profit, that's investing. Right? In this scenario, the undertaking, bases the decision on a reasonable judgment made after a thorough investigation of the soundness that the endeavor has a good probability of success. But what if the same person spends money on an undertaking that shows a high probability of failure? Well, in this case, that's speculating. The success or failure depends primarily on chance or an uncontrollable external, forces or events. The primary difference between investing and speculating is the amount of risk. High speculation risk or high risk speculation is typically akin to, gambling, whereas low risk investing uses a basis of fundamentals and analysis. So, let's start off talking about investing. So, investing can come in many forms, monetary, time, or energy based. In the financial sense of the term, investing means the buying and selling of securities such as stocks, bonds, ETFs, mutual funds, and just a whole slew of other financial products. Investors hope to generate income or profit through a satisfactory return on their capital by taking on an average or below average amount of risk. Income can be in the form of the underlying asset appreciation in value, in periodic dividends or interest payments, or even in the full return of their spent capital. Now, most often, investing is the act of buying and holding an asset for the long term. We're going to classify long term holding as at least 1 year. Now, let's consider a large, stable, multinational company as an example of investing. This company may pay a consistent dividend that increases annually, and it may have a low business risk. An investor may choose to invest in this company over the long term to make a satisfactory return on their capital while taking on some pretty low risk. Additionally, the investor may add several similar companies across different industries to their portfolio to diversify and further lower their risk. Now, analysis and research is a key part of the investment process. It involves evaluating different assets, sectors, and patterns or trends that occur in the market. Investors can use tools like fundamental or technical analysis to choose their investment strategies or design their portfolios. Now, by using fundamental analysis, investors can determine what factors affect the value of securities, from microeconomic to macroeconomic factors. Technical analysis, on the other hand, uses statistical trends such as security prices and volumes to find opportunities in the market. Investors may have, many options available for them to invest their money. Brokerage accounts give investors access to a variety of securities. By opening an account, investors are, you're going to agree to make deposits and then place orders through that firm. Now, the assets and income belong to the investors, while the brokerage, they're going to take a commission for facilitating the trades. And then, with new technology, these days, investors can now invest with robo-advisors as well, right? And a robo-advisor is just an automatic investment company that uses an algorithm to come up with investment strategy based on investors' goals and risk tolerance. So then that leads us into speculating. So with speculating, this is going to be the act of putting money into financial endeavors with a high probability of failure. Speculating seeks abnormally high returns from bets that can go one way or the other. While speculating is likened to gambling, it's not exactly the same. Speculators try to make an educated decision on the direction of their trades. However, the inherent speculative risk involved in the transaction tends to be significantly above average. Now, these traders buy securities with the understanding that they will be held for only a short period before selling. They may frequently move into and out of a position. As an example of a speculative trade, consider a volatile junior gold mining company with an equal chance over the near term of skyrocketing from a new gold mine discovery or going bankrupt. With no news from the company, investors would tend to shy away from such a risky trade. However, some speculators may believe the junior gold mining company will strike gold and may buy its stock on a hunch. Now, this hunch and the subsequent activity by investors, this is what's called speculation. Now, speculative trading does not have its downfalls, right? Uh, when there are inflated expectations of growth or price action for a particular asset class or sector, values are going to rise. When this happens, trading volume increases, eventually leading to a bubble. Now, this happened with the dot com bubble. Investments in internet companies grew exponentially in the late 90s, and the valuations were rising rapidly. The market crashed after 2001, causing major tech companies to lose a large chunk of their value, and a whole bunch of the other ones just being wiped out completely. And then, of course, there are different types of speculative traders. Day trading is one. Day traders don't necessarily have any specific qualifications, rather, they are labeled as such because they trade often. They generally hold their positions for a day, closing once the trading session is complete. A swing trader, on the other hand, is going to hold their position up to about several weeks, hoping to capitalize on gains during that time. Then this is accomplished by trying to determine where a stock's price will move, taking a position, and then making a profit. Now, there are some different trades and strategies you can use as speculators. One of them is going to be futures contracts. Buyers and sellers agree to the sale of a specific asset at an agreeable price at a predetermined point in the future. The buyer agrees to buy the underlying asset once the contract expires. Futures contracts are traded on exchanges and are commonly used when trading commodities. Another one's going to be put and call options. So, in a put option, the owner of the contract has the right, but not the obligation, to sell any part of security at an agreed upon price at a specified period of time. Now, a call option, on the other hand, allows the contract owner to buy the underlying asset prior to the contract expiration date at a specified price. Then, of course, there's short selling. And when a trader short sells, they speculate that the price of security will drop in the future and then, take a position. Popular strategies speculators use range from stop loss orders to pattern trading. With a stop loss order, a trader tells a broker to buy or sell a stock when it reaches a specific price. By doing this, the investor is able to minimize their loss on the stock. Meanwhile, pattern trading uses trends and prices to identify opportunities. It's used in technical analysis. Investors employ this strategy by looking at past market performance to make predictions about the future of an asset, a feat which is very challenging. I mean, you can't really predict where it's going to go. The quote that comes to mind is past performance doesn't indicate future performance, right? So of course there's some special considerations. Both investors and speculators put their money into a variety of different investment vehicles, including stocks and fixed income options. Stocks or equities represent a certain percentage of ownership in a company, and these are purchased on exchanges or through a private sale. Companies are ranked by market cap or total market value of their outstanding shares. Mutual funds and ETFs are also popular investment choices. A mutual fund is just managed by a fund manager who uses the pool of money from investors to purchase, various assets and securities. And then ETFs hold a basket of underlying assets and their price change throughout, the trading day, just like those of stocks. Then you've got fixed income assets. These are going to include bonds, bills, and notes. These can be issued by corporations or various levels of government. Many fixed income assets are used to fund projects and business ventures and pay interest before they mature, at which time, the vehicle's face value is paid back to the investor. As an example, a bond issued by the U.S. Treasury matures at 30 years and pays investors interest biannually. And of course, investors may want to consider the holding period for their investments and their tax implications. The holding period determines how much tax is owed on the investment. This period is calculated from the day after the investment is purchased until the day it is sold or disposed of. The IRS considers holdings of 1 year or more to be long term. Anything below this is considered short term. Long term gains are generally taxed more favorably than short term ones. So, what's the lesson learned here? What can we take away? You know, well, let's start off with the main difference between speculating and investing is going to be the amount of risk involved. And then investors try to generate a satisfactory return on their capital by taking on an average or below average amount of risk. Speculators are seeking to make abnormally high returns from bets that can go one way or the other. And then speculative traders often utilize futures, options, short selling, a bunch of different trading strategies. So, you know, a lot of investors are they're long term. They're holding things for a year or more, and a lot of speculators are holding things for anywhere from a couple days to a couple weeks, maybe even a couple months, depending on the situation. So, but I hope you guys got some good information out of this, and you can, I try to shy people away from doing, speculative investing, but if you have enough money going into your retirement and investment and all that stuff, and you have a little money to the side, you can try speculative investing, futures tradings, options, and stuff like that. Some we'll call it fun money. So, I don't want you to think like you shouldn't do it. I mean, if you have the extra money and you're not afraid of losing all of that money, like, sure, play around with it. You'll see if you like it. But hopefully, you guys learned a thing or two. I enjoyed making this video. If you liked it, hit that like button. If you're not subscribed to the channel, subscribe to the channel for future content. But until I see you guys in the next one, y'all be safe.